But now the next issue after the recognition of the provision is the measurement. Measurement of provision. How a provision will be measured. Now, IAS 37 give us the guidance. Uh, as per IAS 37, when we measure the provision, the first thing we need to consider is that it should be a best estimate. A provision should be a best estimate. Best estimate means when we are measuring the provision, we have considered all the relevant factors in measurement of the provision. If the measurement require a professional judgment, we have also used that judgment in that measurement, then it means we are measuring the provision at best estimate. For example, if we are measuring the provision for an legal issue, then obviously a lawyer judgment would be there. If we are measuring the provision for dismantling cost, then we need the some inputs from the engineers, civil engineers as well. So best estimate means the provision in which all the relevant factors are considered, that provision will be a best estimate. Further, according to IAS 37, when we are measuring the provision, we have to consider whether we are expecting single outcome or multiple outcome. Single outcome means, for example, if there is an court case, then we are expecting a single outcome. And multiple outcome means we are expecting more than one outcome. And the example where we expect multiple outcome is warranty cost. Warranty cost is an example of area of provision where we expect multiple outcomes. Like for example, if company gives the warranty, they may expect that uh, there will be no warranty issue in a product. Then the second outcome they would be expecting, there would be some minor defect in a product which we need to repair. And then they might be expecting also that there will be some product which require major work and there are major defects in that product. So that means in a warranty cost provision, we have multiple outcomes. Now, IAS 37 says if we are expecting a single outcome, then we will measure the provision on the basis of most likely outcome. We will measure the provision on the basis of most likely outcome. For example, if, as I give an example of a court case where we expect a single outcome, now your lawyer tell you that there is 20% chance that you will find the guilty and you will be fined with $20,000, and then there is 50% chance that you may be fined with $60,000, and then there is 30% chance that fine may be $90,000. Now, in all these three outcomes, we will select the most likely outcome, and the most likely outcome is 50%. So we will recognize a provision at $60,000, at $60,000. And where we are expecting multiple outcomes, in that case, provision will be measured at expected value. We will measure the provision at expected value. And how we will determine the expected value? For example, let's say company has sold units, sale is 20,000 units with a 1-year warranty, and company, according to company historical data, 80% products would have just a minute. Okay. So 80% products would have no defects, %15 products would have minor defects, and 5% products would have major defects. And repair cost if all the products have minor defects would be $200,000, and if all the products have major defects would be $500,000. So in this case, the expected value will be calculated. The 80% products have no defect, so there will be no cost. 15% product would have minor defects, and in case of minor defects, if all the product has a minor defect, the repair cost will be $200,000. And if all the products has major defects, the repair cost would be $500,000. So it will give you the answer of $30,000, 15% of 200, and 5% of 500,000 will be 25,000. So the expected value will be 50, 55,000 would be the expected value. And at that expected value, we will recognize the provision of warranty cost. So provision should be a best estimate, and best estimate should consider all the factors, including single outcome, multiple outcome, and if we need a professional judgment, that should be incorporated in measuring the provision. And another factor you need to consider in the measurement of the provision, and that factor is if time value for money is material, then provision must be discounted at present value. Provision should be discounted at present value using pre-tax rate of return. If time value of money is material, then a provision must be discounted. Now, when the time value for money will be material? Now, if to settle a provision we need more than a year, then it is presumed that time value for money is material. If to settle a provision we need less than 1 year, then there is no need to incorporate the time value for money. But where we need to incorporate the time value for money, then obviously we need to discount the present value. And keep in mind that when you will discount the present value, the rate of return which you are using, that should be, dear student, there that must be a pre-tax rate of return. Pre-tax rate of return, pre-tax cost of capital of the company, not post-tax, not after tax, before tax, before tax, pre-tax rate of return. If time value for money is material. So these are the things which we need to consider while measuring the provision, while measuring the provision. Now, reimbursement. Reimbursement. Reimbursement means that the expense will be repaid, incurred by the company. Now, in case of provision, you might have insurance cover. To cover the expenses relating to the provision, you might have insurance cover, or the expenditure incurred by you to settle the, let's say, like a warranty cost, will be settled by the manufacturer. Manufacturer of the product. For example, A Limited is the manufacturer, then it is you. You are a dealer. You are a dealer, and then there is a customer. Now, manufacturer provide you a good, and then you sell that good to a final customer. And the good which you are selling to customer are with, let's say, a warranty. And when there is a warranty claim, obviously customer come to you and ask you to fulfill the warranty. And the manufacturer has asked you that you should compensate the customer. And when you will compensate the customer, then the manufacturer will repay you the cost of the warranty or the repair. Now that thing is known as reimbursement. Now, what will be the accounting for reimbursement? Now, to account for the reimbursement, you need to remember certain points. Number one, reimbursement will be recorded. Reimbursement will be recorded if it is virtually certain that entity will be reimbursed for expenses. So first of all, it should be virtually certain that you will be reimbursed. Virtually certain means there is almost 100% chance that you will get the reimbursement. If it is not virtually certain, then you cannot recognize a reimbursement asset. Number two, reimbursement cannot be more than the value of provision. The value of the reimbursement cannot be more than the value of provision. Now, if your value of the provision is $10,000, then reimbursement cannot be more than $10,000. Okay? Because reimbursement cannot be more than the expenditure. Now, for example, if you are traveling for some official work and you have incurred $10,000 expense on that trip, then obviously the office will reimburse you up to $10,000. If the office is giving you $12,000 against the bills of $10,000, that means the extra 2,000 is something else. That might be your salary. That might be something else, but that cannot be a reimbursement. So reimbursement cannot be more than the expenditure. So the same principle will be applied, that the reimbursement cannot be more than the value of the provision. And number 3, reimbursement asset will be recorded separately in statement of financial position. The reimbursement asset will be recorded separately in a statement of financial position. Now, what does this mean? For example, the provision we are going to record, let's say, is $2,000, and there is a reimbursement which is virtually certain that you are going to receive is $1,800. Now, this is profit and loss account. In profit and loss account, you can report the net expense of $200. 2,000 minus 1,800. $2,000 expense and $1,800 is an income, reimbursement income. So the net expense is 200 in profit and loss account. But in statement of financial position, you have assets and you have liabilities. Now, in statement of financial position, it is not allowed that you net the reimbursement asset and provision liability and show 200 net liability in a statement of financial position. It is not allowed. In statement of financial position, the reimbursement asset will be recorded separately in asset side of balance sheet, and provision will be recorded separately on the liability side of the financial position. You cannot net the provision and reimbursement asset in a statement of financial position. So that's why you are required to record the reimbursement separately in a statement of financial position. So that was about the reimbursement. Now some specific specific issues regarding IAS 37, regarding provision. The number one, future event. Dear students, while measuring the provision, you should while we are measuring the provision, we should consider the future events or future changes. Like for example, if I give you an example of warranty cost. Now, in the previous year, when we have a warranty claim, we use some old machinery to repair the product, and we have incurred certain expenditure. Now, in a current year, we have again need to record a warranty, and we are expecting there will be some products which will be returned, and we need to repair. Now, to repair the product, we are using a new technology. And if we're using a new technology, then the cost of repair will be reduced by 20%. Now, this change should be considered in measuring the provision. Another example, for example, uh, in your area, in your jurisdiction, currently there is no law which require the company to you can say to uh, protect the environment. Your company is throwing the waste in a river, and there is no law which stop you to do this and impose any fine. And it is also not your constructive obligation. But at the year end, you are virtually certain that the government is going to make a law, and if that law is made, that would require the companies to pay fine for last 5 years activities which has polluted the environment and water in the rivers. Now your company is doing it for several years, and it is now certain that law will be passed and you have to pay the compensation. Now, this event which is going to happen in the future, that law is going to be made, it should be considered now, and you should recognize a provision. So such type of event should be considered while measuring the provision. Number one. Number two, no provision should be recognized for future operating costs. IAS 37 does not allow to recognize a provision which is relating to future operating costs. For example, if I give an example of future operating cost, purchase of assets, marketing, expenses, marketing expenses you're going to incur in future, any type of training cost, trading losses, all these are example of future operating costs. And IS 37 does not allow to recognize the provision for such item. Because to recognize a provision, there should be a past event. There should be a past event. We discussed the recognition criteria that provision is recognized when there is a present obligation which arise due to a past event. That means we cannot have an obligation without a past event, without an obligatory event. We cannot have a provision. It is certain. And in future operating costs, there is no past event. All events are relating to future. So that's why we cannot recognize a provision for future operating costs. Examples are purchase of asset, updating the assets, marketing expenses, training costs, trading losses, and any type of such expenditure, we cannot recognize the provision. Got it? Then we have onerous contract. Onerous contract means you have signed a contract, for example, for a sale price of $100, but now you are expecting that expected cost to fulfill the contract would be 120. So this is an loss-making contract. Such contracts are known as onerous contracts. And for onerous contract, we recognize the provision. We recognize the provision immediately. For onerous contract, we recognize the provision immediately. But we recognize the provision immediately at the lower of expected loss or the amount which we can pay to exit the contract. So if I can exit the contract by the payment of $15, then we will make a provision at 15. Otherwise, we will make a provision at $20. Onerous contract. Onerous contract fulfill all the recognition criteria of provision. Just a minute. So we are doing IAS 37 and IAS 37 is in volume 2. I have provided 3 volumes of SBR notes and IAS 37 in volume 2. So we have, let me check the things which we have discussed. Okay. Now, the last thing in the provision is about the restructuring in specific issues. We are discussing a specific issue. We have discussed the future event, future operating cost, and onerous cost contract. The other specific issue is about the restructuring. Now, the restructuring is basically a program by the entity in which the management change the scope of the business, change the scope of the business, or they may change manner of doing business. Manner of doing business. So the program which change the scope of the business or manner of doing business is known as restructuring. Is known as restructuring. Now, for example, if I am going to shut down one of my factories, if I'm going to shut down dear student, I think you will find these notes at LMS of Hamzah Academy. They have uploaded the material on Hamzah Academy. Okay. Or otherwise, you can, if you don't find there, you kindly contact directly with the coordinator. They will provide you. All the material has been given to the coordinator, and I think they have uploaded on LMS. And if you are enrolled on LMS, you will find there. And once the WhatsApp group are made, then I will share in a group personally as well. Okay. So let's say the scope of business means I am going to shut down one of a factory in a specific area. Then it means I'm changing the scope of my business. Okay. And when I will change the scope, I am going to shut down one of my factory, then obviously there will be some termination. We will make some employees redundant. And by law, we have to pay the redundancy cost, compensation, termination benefits. For that, I have to recognize a provision. Manner of doing business means the way we conduct the business, we have changed. For example, now previously we were operating through 20 outlets in the country, and in each outlet I have dozens of the employees. But now I shifted my outlets on e-business, e-commerce business. So now I am doing online selling the product online through social media using Instagram, Facebook, or my website, Amazon, XYZ. Now, when I have changed the way of my business, instead of selling the product through outlets, now I will sell the product online. Then obviously I need less employees. I does not need any outlet. I just need a warehouse in any part of the country or world, and internet speed, a website, and 10 to 5 maybe people to manage that account, and 5 to 10 employees maybe I need to dispatch the order. So the manner of doing business also lead to termination, also lead to redundancies. So whenever there is change in scope of business, or there is a manner of doing business is changed, that would be a restructuring. And in restructuring, there will be employees who will be made redundant, and we have to pay them compensation. So for restructuring, you need to recognize provision. Now, when that provision should be recognized, that is a question. For that, let's read the paragraph. Restructuring is a program that is planned and controlled by the management and materially change either the scope of business undertaken by entity or the manner in which the business is conducted. Examples of restructuring include sale, a termination of line of business, closure of business location or relocation of business activities, change in management structure, fundamental reorganization that have material effect to the nature and focus of the entity operation. One of the main purpose of IAS 37 was to target the abuse of provision for restructuring by introduction is strict criteria about when such provision can be made. A provision for restructuring is recognized only when entity has constructive obligation to restructure. Have a constructive obligation to restructure. And that constructive obligation arises if there is a detailed formal plan of restructuring. Detailed formal plan of restructuring means a plan has been finalized, identified the business location which are going to be affected, the number of employees going to be affected by that plan. All such thing has been finalized. So you must have a detailed formal plan. And number two, that plan has raised a valid expectation among the employees that the restructuring will be done. Now, how that valid expectation can be created? There are only two ways. Number one, before the year end, the management has started to implement the plan. So when you start to implement the plan, it will create expectation. Or if you haven't started the implementation of the plan, you at least announce the plan publicly before the year end in a way that it creates expectation that the restructuring will be carried out. So if these two conditions, you have a formal plan and that plan has created a valid expectation before the year end by implementing the plan or by announcing the plan to the affected party, then we can recognize a provision. And again, when we will measure the provision, only the direct expenditure will be included, like termination charges or any legal fees which you have to pay. But the future operating cost would not be included in measuring the provision, like retraining, relocating, marketing, or investment in a new system or distribution channel. Such expenditure should not be included in the measurement of the provision as we have discussed earlier. So that is the provision for restructuring. Contingent liability. Dear student, if we have a contingent liability, that contingent liability will be disclosed in a financial statement. We will just give a disclosure. We do not recognize the contingent liability in financial statement. We give a disclosure. And what is a contingent liability? Contingent liability is a possible obligation due to a passive, and its existence will be confirmed only by the occurrence or non-occurrence of some uncertain future event. Such obligations are known as possible obligation, and they are known as contingent liability. For example, there is a case against you by the employee or a customer, and you take a plea in a court that it is not your fault. There are some other issues which cause the problem, and court order the investigation. If in investigation you find guilty, then you have to pay the fine. But that depends on the outcomes of the investigation. So it will be a possible obligation. That will be a possible obligation. Or it might be a present obligation. But outflow of economic benefit is not probable. or cost of the expenditure cannot be measured reliably. If even it is a present obligation, but outflow of economic benefit is not probable, or the cost of the expenditure cannot be measured reliably, in that case also, such obligation will be known as a contingent liability. And for contingent liability, we will provide only a disclosure in financial statement about the nature of liability, possible for financial effect, any possible reimbursement, or any uncertainties surrounding that contingent liability will be disclosed in a financial statement. But we do not recognize the contingent liability. Similarly, the contingent asset is a possible asset which arise from the past event, but will be confirmed in future. So unless you are certain, virtually certain that you will get something, for example, if you have filed a case against your company and you are virtually certain that you will win the case, then it will be your asset. But if you are not virtually certain, but you think it is probable that you will win the case, then that will be your contingent asset. And again, the contingent asset will be disclosed in a financial statement. We will only disclose the contingent asset in a financial statement. So contingent liability and contingent asset will be disclosed in a financial statement. They would not be recognized. They would not be recognized. Okay. So that is the IAS 37. Any question? Okay. Now we will do a question, case study from the past paper, and you can see the question at your screen. This is the question number 2 of the paper. And I told you in the last class, the question 2 will be consist of an accounting issue and plus and ethically. So the background of the question is B company has a controlling interest in a number of entities. Group results have been disappointing in a recent years, and the director of B company have been discussing various strategies to improve the group performance. The current financial year end is 31st December X5, and the following personals are relevant to the scenario. Mr. Shaw, the head accountant of B company. Head accountant of the B company. Mrs. Davis, the chief executive of B company. Mike Starr, the nephew of Mr. Shaw, and Mrs. Shaw, the wife of Mr. Shaw. Now, group restructure, the exhibit number 1. Group restructure. Kindly read this paragraph. Read the case study. Read it yourself, then I will explain it. Please read it. Okay. Hopefully you have read it. So, Mr. Shaw is the head accountant of a B company, but he is not the member of the board of directors. That means he is not a key decision maker. The people who sit in a BOD, board of directors, they are the key decision makers. Mr. Shaw is not the director, he is the head accountant. And the Mrs. Davis, who is the CEO of the B company, is also an ACCA member. During 2005, Mrs. Davis revealed a plan to Mr. Shaw of potential restructure of the B company which had been discussed at board meeting. The restructuring plan include a journal analysis of the expected cost which would be incurred should restructure take place. These include legal fees, relocation costs for staff, also redundancy costs for the number of employees. One such employee to made redundant is the Mike Starr, is the nephew of Mr. Shaw. Mrs. Davis insisted that Mr. Shaw should include restructuring provision for all the expenditure in a financial statement of B company for the year ended December X5. Mrs. Davis argued that even if the restructure did not take place exactly as detailed, similar level of expenditure are likely to be incurred on alternative strategies. It would therefore be prudent to include the restructuring provision for all expenditure. None of the staff other than Mr. Shaw have been notified of the plan. Although Mrs. Davis has informed Mr. Shaw that she expects the final decision and the public announcement to be made prior to the authorization of the financial statement. Authorization means after the year-end financial statement will be authorized. So they are saying that in the next year, before the authorization, the plan will be announced to the public. Now, this is the exhibit and the requirement. The first requirement, discuss the appropriate accounting treatment of restructuring costs in a financial statement of the B company for the year ended 31st December 20X5. So what is the appropriate accounting treatment of this restructuring cost? Obviously, it is an IAS 37 issue. Now, what do you think? You have read it, and we have discussed the restructuring and the recognition criteria for provision. What do you think? Whether this restructuring provision should be recognized in December X5 or not? What's your opinion? Vishka says that no provision should be recognized. And the logic of that conclusion, according to Avishka, is that no public announcement has been made during the financial year. And no restructuring plan finalized prior. Avishka is right. He has the appropriate opinion. Look, we discussed that to recognize a provision for restructuring, there should be a formal plan. And if you have read the case study, it seems they does not even have a formal plan. They have just discussed in a group, in a board of directors, that they are considering a potential restructuring. And they have just discussed some other aspects, but they didn't finalize the plan. And there should be a public announcement or there should be an implementation. So both the conditions are not fulfilled yet. So that's why the restructuring provision should not be recognized. Should not be recognized. Okay. Now, let's see. That was our conclusion and our logic. Then let's see how we should construct this answer while in our exam. So for that, I have a written answer as well. Look at how we are starting. We're starting a provision for restructuring costs should be recognized in a financial statement of the B company where the following criteria are met. A reliable estimate can be made of amount of obligation, and it is probable that there will be an outflow of economic benefit to settle the obligation. And there is a present obligation as a result of past payment. That is a general criteria of the provision. First of all, they have discussed that. Then they discuss IAS 37 provision, contingent liability and contingent asset state, that it would be extremely rare that there is no reliable estimate can be made. A best estimate of expenditure required to settle the present obligation should be provided at December X5 should all criteria be met. In the case of restructuring, so first of all, they are discussing the general knowledge of IAS 37. Okay, because restructuring fall under IAS 37. Then they are coming that in the case of restructuring provision, this should only include the direct expenditure arising from restructuring and not associated with ongoing activities. Hence, relocation costs would not be included, as although they relate directly to the restructuring, the cost would be reclassified as ongoing activity. Then they are coming to the restructuring and they are discussing that in measuring the restructuring provision, we should consider only the direct expenditure which are directly related to restructuring. The expenditure which are relating to ongoing activities like staff training costs, relocation costs, marketing costs, updates costs, which is basically future operating costs, that should not be considered as the part of the provision. And then an obligation regarding as probable where the event is more likely not to occur. It is not clear that the restructuring is probable. Mrs. Davis has indicated that alternative strategies are possible and further clarification would be required to ascertain whether these activities would be constitute a restructuring as per IAS 37. So in the case study, Mrs. Davis also mentioned that there are other strategies also possible. How she is saying alternative strategy. Similar level of expenditure likely to be incurred on alternative strategy. So there is alternative strategy is also mentioned in a question by the Mrs. Davis. And when you have alternative strategies, then there is a question mark that whether you have a present obligation or not. And while discussing, she discussed that provision include legal fee and relocation cost for staff. Now, relocation of staff cost means staff training cost, relocating from one area to another. Now, in provision, we cannot include the relocation cost. Okay, so that's why this point is also discussed in answering that we should not include the relocation cost. Then at the end, they are discussing the specific criteria of restructuring. That is only then maybe determine the restructuring cost is indeed improbable. A constructive obligation for restructuring only arises where detailed formal plan exists and a valid expectation of those affected by the restructuring that will take place has occurred. A plan is in place, but management does not yet appear committed as alternative strategies are possible. It is unlikely, therefore, that the plan is detailed and specific enough for these criteria to be satisfied. For example, the specific expenditure to be incurred, the date of the implementation, time frame, which should not be unreasonably long, must be identified. Now, all these things are not identified in the plan. With alternative strategies available, this does not appear to be the case. Furthermore, Mr. Shaw is the only member of the staff who has been notified, not the public announcement has been made. as at the reporting date. Consequently, there is no obligation in existence at December X5 and no provision can be recognized. So basically, they started from the general discussion, then they started the discuss that which value should be included in a measurement of the provision and which should not be, and then they discuss the specific criteria for restructuring provision, and they concluded that provision for restructuring should not be recognized, should not be recognized. The Mrs. Davis has identified that final decision on restructuring and communication is likely to take place before the financial statements are authorized. This would almost certainly be a material event arising after the reporting date, but it should be treated as a non-adjusting event. We will discuss IS10, and you would have the idea about the IS10 as well, that after the year end and before the authorization of the financial statement, that this time period is known as events after reporting period. Now, if you are fulfilling the criteria of provision in a events after reporting period, then it is a non-adjusting event. And if the non-adjusting event is material, we give a disclosure of a non-adjusting event about the nature of the event and possible financial effect. So here, in the last paragraph, they also involve IAS 10. Events after reporting period, because it was mentioned in a question that the plan will be announced and finalized before the financial statement are authorized. That means examiner is indicating that in answering the question, you should also involve IAS 10. And if we are announcing the plan after the year end, then will be a non-adjusting event, and that non-adjusting event will be disclosed in the financial statement. Got it? I discussed just a related part of the question, which is relating to IS 37. Okay. Now, okay, sure. Now we will move towards a new topic, which is asset held for sale and discontinued operation, the next accounting standard. But before that, now we will take a break of 10 minutes, and after the break, we will resume the class. Kindly take a break. Okay, welcome back. So the next topic is IFRS 5, non-current asset held for sale and discontinued operations. In this accounting standard, we will discuss about the measurement, presentation, and disclosure of non-current assets, which are now classified as held for sale or a disposal group. And we will discuss about the presentation of the discontinued operation. Now, this accounting standard applies on all non-current assets and on all disposal groups, but there are some certain exceptions on which this accounting standard is not applied. This accounting standard does not apply on deferred tax asset. It will not be applied on deferred tax asset, IAS 12. It would not be applied on employee benefits, assets arising from employee benefit, IAS 19. It does not apply on financial assets. It does not apply investment properties, IAS 40, investment properties which are carried under fair value model. It does not apply on biological assets measured at fair value, IAS 41, and it does not apply on a contractual rights under insurance contract. So these are certain exceptions on which IFRS 5 is not applied. Now, there are some definitions. Disposal group. What is a disposal group? A disposal group is a group of assets to be disposed of, to be disposed of. By sale or otherwise together as a group in a single transaction, and liabilities directly associated with those assets that will be transferred in transaction. The disposal group may be a cash generating unit, a single CGU, or a part of CGU. So disposal group means a part of a company or company itself in which we are going to dispose of number of assets with their associated liabilities. That group is known as a disposal group. Now, classification of non-current asset disposal group as held for sale. Now, in IFRS 5, as we name this standard non-current asset held for sale or asset held for sale, means we're talking about those non-current assets which we are going to sell, which were previously we were using it. Previously we were using those assets, but now we decided to dispose those assets. And those assets about which we have decided that we are going to dispose of are known as non-current asset held for sale or a disposal group. Now, when we classify a disposal group or a non-current asset as held for sale, an entity shall classify a non-current asset or a disposal group as held for sale if the carrying amount of those assets or those group of assets or a disposal group to be recovered principally through a sale transaction rather than through the use of that asset or group of assets. So, for example, if I have purchased, let's say, a machinery and I was using that machinery for last 6 years, but now I decided that now I will sell that machine. I will dispose of that machine. Now that means I'm not going to use anymore that machine, that plant, that equipment. Instead of using, now I am going to sell it. So the amount or benefit from that machine which I will recover now is only depend on a sale transaction. So such assets will be classified as held for sale, as held for sale. Got it? Any question? Keep, but let me clarify one thing. If you trade the asset, if your business is trading of a plant and machinery, trading of car and vehicles, then IFRS 5 is not applicable. Then IS 2 will be applicable, inventory. Here, when I say held for sale, means previously I was using that asset. We have a textile company. We have machine which we use to make the textile product. Now I want to purchase a new machine. And in order to that, I decided to dispose of the old machine. That machine will be classified as held for sale. Okay. Got it? Now, there are some conditions which must be fulfilled if we want to classify a non-current asset or a disposal group as held for sale. And those conditions are, number one, the asset or a disposal group must be available for immediate sale in a present condition, subject only to usual and customary sales terms. This is the first condition. Now, what mean by that condition? What meant by that condition? For example, if a company decided that they want to sell a machine, but they are still receiving the production order, and those production orders will be fulfilled by that machine, usage of that machine about which we are talking about, that management want to sell. That means that machine is not available for immediate sale because we are still using that machine. So the condition is not fulfilled. And if the condition is not fulfilled, then we cannot classify that machine as held for sale. Okay. Similarly, you have a property and you want to sell that property, but there is a court case going on that property. There is a legal case, there is a court case on that property, and there is a stay order, and which does not allow you to sell the property immediately. So that means unless the court case is settled, you cannot sell that property. Again, the property is not available for immediate sale. But customary and usual delays are allowed. For example, you want to sell a property. There is no court case. There is nothing problem in that property. But obviously, the customer will come. They will see the property. They will negotiate, and it may take some time. Such type of customary practices are allowed. But other than that, if there is any event which is creating a problem to sell a property, like I told you, I'm still getting the purchase production orders. We have a court case. Then in that case, the property, the asset is not available for immediate sale in a present condition. So this is the first condition. The second condition is the sale must be highly probable. If the first condition is fulfilled, then in the second condition, the sale must be highly probable. And in order to be a highly probable, these are the factors need to be considered. Number one, the price at which asset is actively marketed for sale must be reasonable in relation to current fair value. For example, if you are demanding 10 million US dollar for an asset, but the reasonable fair value of that asset is $6 million, then that means the sale is not highly probable because no one is ready to buy that asset at $10 million. So you must market your asset at a reasonable fair value. You does not market your asset at a fair value at which it is not possible to sell the asset. Number two, unlikely that significant changes will be made to plan or the plan withdrawn. Means we are not expecting that we will withdraw the plan. Withdraw the plan means we will change our intention. And we will change our intention not to sell the asset. Okay, so it is unlikely that we will change our intention. Number three, the management at appropriate level has committed to plan to sell the asset. The asset is actively marketed. Active program to locate the buyer has been indicated. And the sale expected to qualify for recognition as completed sale within 1 year from the date of classification. That means the sale will be completed within 12 months from the date of classification. If we expect that sale will take more than 12 months, then we cannot classify the asset as held for sale. So these are the conditions which should be fulfilled in order to classify an asset as held for sale. Held for sale. If these conditions are not satisfied, then we cannot classify an asset as held for sale. Measurement of non-current asset and presentation of the non-current asset held for sale. Initially, those assets will be accounted for as per their respective accounting standards, like property, plant, and equipment in IAS 16. Then, when we classify those assets as held for sale, they will be measured at the lower of fair value less cost to sell or their carrying value. Fair value less cost to sell or carrying amount, whichever is lower, and that amount, the asset will be recorded or measured in IFRS 5. Now, if the carrying value of the asset is 10, but fair value less cost to sell is 8, in that case, first of all, we will impair the asset by 2 million, and then we will record at the $8 the asset as held for sale. But principally, we will go for the lower of. And if the carrying value is more than fair value, then first of all, we will record the impairment as per IAS 36, and then we will record the asset at fair value less cost to sell. And if the carrying value is less than fair value less cost to sell, then there is no need to impair that asset. Number three, the non-current assets which are classified as held for sale will not be depreciated from the classification, date of classification. Non-current assets held for sale are not depreciated from the date of classification. And any changes in a fair value subsequently or a further impairment or reversal of impairment will be recorded in profit and loss account as per IFRS 5 or IAS 36. Presentation. The asset and liabilities which are classified as held for sale will be presented separately. Liabilities will be presented in the liabilities area and asset will be presented in the asset area. But the asset held for sale in statement of financial position will be presented below the current asset. You know, in statement of financial position, we have non-current asset, then we have current asset. Now, the asset held for sale, assets held for sale, AHS, will be presented below the current assets. And similarly, the liabilities relating to the asset held for sale will also presented below the current liability, below the current liability. We present the asset held for sale under the current asset, below the current asset, because we are expecting that those assets will be sold within 12 months, will be sold within 12 months. That's why we present those assets under the current assets or related liabilities under the current liability. Any question? Friends, any question? Okay. Can you give an example for grading for say load of? Okay, okay, okay. Let's see the example. Okay, look at the example. Then we will do a question. Now uh, let's say we have a plant. The cost of the plant was, let's say, $1,000, and we have accumulated depreciation on that plant till date is 400. So the net book value of that plant is 600. And we classify that plant now as held for sale. Now, when we classify the plant as held for sale, we need a fair value. The fair value of that plant, let's say, is 610. And the incremental cost to sell that plant, let's say, in case A, that is $5, and in case B, that is $20. So, in the case A, fair value less cost to sell will be 605, and in the case B, it will be 510. Now, if we focus on a case A, in that case, the lower of amount is 600. The entry will be non-current asset held for sale and credit the property, plant and equipment with 600. Because in the case A, the 600 is the lower of. But in case B, The fair value less cost to sell is less. So first of all, we will record an impairment loss. Impairment loss of 20. Sorry, 5, just a minute, just a minute, just a minute. It is 590, not 510, it is 590. It is 590. So in a case B, the fair value less cost to sell, which is 610 minus 20, 610 minus 20, 590. The 590 is a lower amount, and we have a carrying value of 600. So in that case, we will record an impairment loss of $10 and credit the accumulated impairment loss or property, plant, and equipment $10. And when we do this entry, the 600 minus 10, it will become 590. And then we will debit non-current asset held for sale, IFRS 5, debited by 590, and property, plant, and equipment by credit by 590. So that would be the numerical example. Okay, how we will take the load off. Got it? Okay, now let's have an idea that how this topic can be tested in exam. And I told you in the first lecture that in SBR, the mostly he will test you through explanation and the discussion. Now, first of all, let's read the requirement. The requirement on which I'm going to focus is that discuss with reference to the International Financial Reporting Standard whether the director can classify stadium as held for sale. Can director classify the stadium as held for sale? And for that purpose, read the paragraph starting from here till here. Kindly read it. So Liria Company is an internationally successful football club. Liria Co is preparing the financial statement for the year ending 31st October X5, but is currently facing the liquidity problem. Liria Company has entered into a contract regarding its stadium, whereby it will sell the stadium on 30th November X6 and immediately lease it back. The director of Liria Co. wished to classify stadium as a non-current asset held for sale in a financial statement for the year ended 31st October X5, as they believe the sale is highly probable at that date. Okay, this is the information. Now the question is, can the media classify this stadium at 31st October X5 as held for sale? Yes or no? What's your opinion, dear student? Can media classify this stadium as held for sale? Their year end is 31st October X5, and they will sell it on 30th November X6. To classify, it should be available for immediate sale, and sale should be highly probable. In order to be highly probable, uh, management has committed to plan. They have actively marketed the asset. They are expecting that sale would be done within 12 months from the date of classification. So keeping that criteria in mind, what's your opinion? Yes, that is the logic in this information. Look, they are expecting the sale in 13 months. Here, they are expecting the sale in 13 months. Today is 31st October X5, and sale will be done 30th November at 30th November 20X6. So they are clearly going to take 13 months, and the criteria is about 12. So the condition of highly probable is not met. So that's why it cannot be classified as held for sale. Furthermore, especially those students who are coming from ACCA route and they have studied FR. In FR, you have studied IFRS 16. And you know that sale and lease back is a topic of IFRS 16 leases, not non-current asset held for sale IFRS 5. So further, other than that, there is another reason that it cannot be classified as held for sale is that sale and lease back come under IFRS 16, not IFRS 5. So that is a second argument against it that the stadium cannot be classified as held for sale. Got it? Okay, student. Now we will off the class. Okay. Okay. Now we will off the class. Uh, I will contact with the management that whether the notes are available or not. You have made them available or not. If they are made available and you got the notes, keep in mind IS 37 and IFRS 5 in volume 2. In volume 2 of notes. Okay. So kindly the relevant areas which we have discussed. We haven't completed yet IFRS 5. One area is remaining, that is discontinued operation. But that we will discuss in a next class. So goodbye and take care. See you next week.